Hi to everybody. Okay, so we're just here to give a short presentation on how to get mortgage ready, and I suppose it's a very common topic at the moment as people are living at home in small, maybe small apartments or shared houses, and dying to get out and maybe own their own house. So the purpose of this presentation is just to guide you through really what you need to do in preparation for that moment that you do get your application ready together. So what I'll go through here today is the general market and what our customers are telling us, and the various trends that have formed across banking over the last 12 months really. Megan is then going to guide us through how to go about getting mortgage ready. And then we'll just cover off at the end what actually we offer and the various options available to you. So just moving on to the next slide, and really just kind of briefly touching off what trends really have formed over the last 12 months. So aside from obviously the health and economic consequences, COVID has had a very big impact on the way we do things and the way we live. So authentic living is one of them. And I suppose there's a huge interest in sustainability and valuing really what's really important to us. And we're also looking at sustainability in some of the mortgages we do. In particular, the likes of, we offer a green mortgage, and all the banks in the country have started offering green mortgages in the hope that I suppose people maybe start buying energy efficient houses that reduces the carbon print across Ireland. So that's one trend that has definitely started. The second thing is community rising. So more of an appreciation, I suppose, friends and family in the community. We've seen a huge trend of people who are literally working in Dublin the last 10 or 15 years and have moved home to their home county as far as Galway, Kerry, and so on and so forth over the last 12 months, because they now have the opportunity probably to work from home for the remainder of their career. So there's been a huge uptake on that. And what people have really gotten used to is, I suppose, the community spirit, and I suppose having the availability of amenities for their kids to grow up in. The contracting circle, so 65% of adults agree that they now feel closer to a smaller social circle. And I think the government have been part of that we can only maybe visit a smaller circle of people. But people in general have kind of moved towards a trend of probably maybe communicating with friends and family over the phone, and maybe having a small social circle as to who they visit. Self-care then, so obviously exercise has played a massive part over the last 12 months, and we're probably eating healthier. I know that I'm feeling a lot healthier than I have in previous years, and I've gone for certainly more walks than I care to mention. Remote connection then is the next trend, and majority of people believe that working remotely for good is good for life balance, it's good for your mental health. But the general consensus, and we were just talking actually prior to starting this, the general consensus out of all the companies that we're talking to is that people want a hybrid approach, and the option maybe to work at home maybe 2 days a week, but actually come into the office for that social interaction at least 3 days a week. So we see, I suppose, the second half of this year, many people actually coming back to the workplace because it promotes innovation and good ideas. So that is one trend that will probably last into the future. And the last one then is considered consumptive. So a higher proportion plan to spend more on home-based activities. So I'll touch off the supply of property in a second, but a lot of people we have found over the last 12 months have decided, you know what, we're not going to buy a new house, where we're going to renovate our existing house, build a bigger kitchen, build a bigger living area, build a home office, or build a gym. So that is a huge trend also in the States. So what they've noticed in the States is that people have started buying bigger houses, maybe out the country more, which includes a home office and a gym. And what tends to generally happen is, if it happens in the States, it usually moves to London, and it'll eventually end up in Ireland. So I suppose watch the space for people maybe buying bigger houses out the country or on the commuter belt of Dublin for that bit of space. So just on to the next slide. So the banking trends and what impact that has had, I suppose, on COVID. So all these trends that I'm going to mention here have already been in play the last couple of years. Just COVID has massively accelerated these particular ones. So 52% of us plan to use less cash less often. Apologies. So I don't know about you, but I haven't had a 10 or 20 euro note in my wallet for the last 12 months, and I probably won't into the future. So that's one big trend. 67% plan to use contactless payment more often. So I would say the majority of people on this call are now using contactless all the time. And I would say that figure is even going to go higher and higher. If you look at countries like Sweden, it's practically fully contactless there. Even homeless people on the street now have a contactless payment to be able to take money from passers-by. So that's a huge trend that has formed. 26% of us plan to use mobile payment apps more often. And this is a particular trend that is really starting to accelerate. All the banks in every country, I say in every world, have really improved their apps to be able to make payments quicker, faster, and more efficient. So that is a trend that has been very positive. So a third plan to visit the bank branch less often. And we've recently announced, actually only in the last week, that we intend to close a third of our branch network across the country. And that's based on footfall numbers. Less and less people actually coming into the bank to do their transactions. Would you believe that only 10% of all transactions being done in the bank at the moment are being done in an actual branch? 90% of transactions are being done online and through the mobile app. So you can see that all banks are going to be trimming down in size. And as I said last week, Bank of Ireland actually announced a reduction of a third of their branches across the whole country. And then the last one then is 40% plan to have regular savings more often. So if one thing that this has taught us is that we have the ability to save and to get into a routine. And over the last 12 months, people, I suppose, have money that they've never had before, because they've had the opportunity to save. So we find that once people are in a regular trend of saving, that they tend to continue that into the future. Megan will also just cover off in further slides how you can do that for a mortgage, and there's a particular mortgage saver product which actually helps saving for a mortgage. So she will cover off that. And on to the next slide. And lastly, then, just a quick property market snapshot. So residential prices really across the country have increased by 0.2% nationally in the year as far as November. That was up actually, sorry, that was down previous to 1.1% in the previous 12 months. What we've actually found is there's certain demand in certain pockets of Dublin. Generally, prices around the country have actually gone up. As I said, people have moved home to their local county, which has led to, I suppose, a lack of supply in certain areas, and the prices have gone up. We see a similar trend, I suppose, in Dublin, in that the lack of supply and lack of construction all around Ireland at the moment, because all construction workers have stalled, has led to actually prices increasing. So we would see in certain pockets of Dublin, certainly kind of South Dublin areas, particular Dublin 14, Dublin 16, Dublin 6, all areas continue to have very strong demand, and those prices are actually going up and up all the time. There's a huge pent-up demand for people looking to buy a house at the moment. We've actually probably never been as busy with applications. We're way back up over our pre-COVID levels. So as I said earlier, people have been, I suppose, living a different sort of life the last 12 months, living in their apartment and maybe small room, and they're finding more value by maybe moving to locations that previously were not commutable to work, but maybe now more are achievable. So although price inflation has increased, the market continues to be characterized by mismatch between supply and demand. And really, until the supply meets demand, which probably won't be in until next year or even the year after, you can, I suppose, you can hope to see that prices will stabilize somewhat, but likely to increase more and more. And we find with inflation, which is currently 0.7%, materials and construction work and new property is starting to increase in value every week. And you'll find that across the board with all items. If you look at electricity, all the electricity companies have come out in the last 2 weeks that prices will increase by at least 5%. So you're going to find in the next couple of years, due to COVID, that the price of everything starts increasing, and maybe in time the likes of salaries will also increase along with that as well. So that's a quick kind of properties snapshot. I'm going to guide you to the next slide, and Megan's going to guide you through what you actually need to do to get mortgage ready.
Thanks so much, Niall. So on this slide, I will go through, first of all, the central bank mortgage regulations. So general rule of thumb, and then kind of what exceptions are available to you. So in 2015, the central bank introduced these regulations basically to stop kind of those 100% mortgages and to prevent excess credit, and to set the ceilings basically on the amount of money that you can borrow to buy a property. So the first central bank limit is your loan to value. So the loan to value requires you to have a minimum deposit before you can get a mortgage. So the minimum deposit depends on the type of buyer that you are. So if you're a first-time buyer, you need a minimum of 10% deposit. If you're a second or mover, you need minimum 20%, and a buy-to-let or investor mortgage, you need 30%. So that's just the absolute minimum that you need to have towards your property. The second limit is your loan to income. So that restricts the amount of money you can borrow, and it's up to a maximum of 3.5 times your income or times your combined income if you're applying as a joint applicant. So for example, if you have a sole or combined income of 100,000, 3.5 times that, you can borrow up to 350,000. But if you're looking at a property at around 300,000, then the loan to value rule of thumb comes into play here. So you can borrow either up to 90, 80 or 70% of that. So really this means that there's a cap on either side. So for example, if you can borrow up to 350, the property price is 300 and you're a first time buyer, the maximum loan that you'll get towards that property is 270,000. So even though you're eligible to borrow more, we won't do that, simply because then at that stage you'd be in negative equity if you've borrowed more than the property is worth. So a lot of people in Dublin have found the 3.5 times your income really restrictive. So there are exceptions available. These are from the central bank. So essentially what happens is we would put forward a recommendation and a request to apply for an exception. So that could be up to 4.5 times your income, or you can get an exception on the amount of deposit that you need. So these are assessed on a case-by-case basis, and they are limited. So there's only a certain portion of mortgages that can be an exception base. These are also property specific, so you do have to have in mind a property of what you're going for, and then we would apply for the exception. The turnaround times on this are usually fairly quick, and if it is declined the first time, we can hold your request on file, so that if an exception becomes available in the future, at least you're kind of in the queuing system. So if you want, you can go on the central bank website and it explains further what these exceptions are. Okay, and then the next slide, what I'm going to go through then is the first time buyer survey. So this is really first time buyer, and it also applies to people who have maybe bought a property before and are back renting, some of the challenges and considerations that they face. So the main challenges here: cost of property, especially in Dublin, it's really high. The ability then to save a deposit, especially if you're renting, the lack of supply of where you'd like to buy, and the affordability of mortgage repayments. So I suppose on the challenges, even there you can see the affordability of mortgage repayments is actually the lowest. If a lot of people are renting in Dublin, usually their rent is so high that they can well show that they can afford a mortgage repayment. Over the savings, this is quite an old survey, so things have probably changed during COVID, but I suppose a lot of the elements will remain the same. So savings, 77% have a plan, and average savings is 538. Again, I think that's probably increased over the past year. A lot of people have increased their savings simply because with COVID and restrictions, they've had limited places to spend their money. So other considerations would be their average monthly rent, their age, their partnership, are they sole or joint applicants? And then the main one would be prepared to commute 10 to 30 kilometres. So a lot of people, we've actually seen that rise in the last year. As Niall mentioned earlier, a lot of people are moving further out of the city centre and towards other parts of the country, just because they have the flexibility now to work from home, and the property prices are a lot lower around the country. So this can be, this might relate to you and it might not. So on the next slide, what I will go through is the Help to Buy scheme. So the Help to Buy scheme is designed for first-time buyers. So it is to help fund your deposit for a new property. So the Help to Buy scheme, it is just for first-time buyers, new builds or self-builds, okay? So it is a refund of income tax and dirt tax paid over the last 4 years. So you can go onto revenue.ie and you can put in your details and PPS number, and it will tell you the amount of relief available to you. At the moment, it is taking a bit longer, but even if you don't have a property in mind or you don't have a mortgage application and you just want to, for interest, see what you'd be eligible for, you can do that. So it's a newly built home or building a new home to live in. You have to have a mortgage of at least 70% loan to value. So as a first time buyer, you can get up to 90% loan to value, but if you do have higher level of savings and you only need a lower loan to value, you need to make sure that that matches with the Help to Buy if you're going to be availing of that. So in July 2020, the government actually increased this from up to 20,000 to 30,000 and from up to 5% to a maximum of 10% towards your deposit. So if you did maybe apply or see last year to see what you were eligible for, this might have increased since July 2020 for you. So with the Help to Buy scheme, you actually don't see that money. It goes directly to the solicitor or developer, and you can use that towards your deposit of your house. That can be used towards your 10% deposit. Okay, so if you are considering a new build, I would definitely look on revenue.ie to see what you're eligible for. But like I said, you don't see any of that money. It goes directly to the developer. Okay, so that's a brief snapshot of Help to Buy. On the next slide, then I'm just going to go into more detail of what Bank of Ireland looks for in an application. So the key factors that Bank of Ireland will look for, these might help or hinder your application. So the first and the main one I suppose we look at is your income. So we look at the 3.5 times your income. This can be on a sole or joint basis. We look at your base income, but we can also look at your variable income. So if you do earn bonuses, health benefits, commission, car allowance, shift allowance, we can look at all those additional extras if you have a track record of this. So if you have a track record over the past 2 to 3 years, we will include that into your income. We'll also at the moment look to see if your income has been impacted by COVID-19. So if you are self-employed or if you're working in an industry that was impacted, are you still on pandemic payments or is your income subsidised by the government? So we will take that into consideration. It doesn't mean it's a no-go. It just means that you might only be able to get an approval in principle and you can't go any further until we assess your income at that point. What I would say is if you do think you were impacted or if you have any queries and concerns about this, you can feel free to contact us directly to see if it would impact your chances of getting a mortgage in the next year or so. So we'll also look at your financial history. So this could be a previous mortgage that you had or previous personal loans or credit card. We'll really look to see if you defaulted on any of these or if you have any arrears. So if you had a previous mortgage and it ended in arrears, is there a background story to this? Is there a reason why? With personal loans, it would be the same thing. If you did default or had arrears on any of your previous loans, it's not necessarily, again, a no-go. If you are honest from the offset and there's a good background story and we can still put forward a good recommendation for you, we can look at that for you. Also with financial history, a lot of first-time buyers think that they might need to take out a personal loan or credit card to show that they can actually repay a loan or a financial commitment. That's not the case with ourselves. You don't have to have a credit history built up. As long as you have sufficient savings and a good account operation, we don't need a previous loan or credit card to show you can afford mortgage. But we will look at your existing financial commitments, okay? So this could be a car loan, personal loan, student loan, anything like that. Really, it depends on how much per month you're spending on existing financial commitments. So if it's a small personal loan each month that's coming out, it might not influence the amount that you can borrow. But if it is a large financial commitment, it may reduce the amount of a loan that you can take as a mortgage. Again, this is kind of, on a case-by-case basis. So if you are worried about your existing loans, if you would prefer to repay them early, feel free to contact us directly. We can do a quick calculator and see how your existing loans may impact your mortgage. So we also then look at your deposit saved. So your deposit saved, as I mentioned, it could be 10, 20 or 30%. So we will look at how your deposit is saved. Is it through regular savings? Is it through the Help to Buy scheme? Some people have inheritance or a gift. If it is via inheritance or gift, you will need to provide additional documentation. So that could be a gift letter, just to make sure that whoever is giving you this money has no interest in the property, it's non-refundable, it's not a loan. If you are getting majority of your deposit by a gift or inheritance or the Help to Buy scheme, we do still need you to have repayment capacity. So if you're paying rent and this is a high repayment capacity level, we will definitely take that into consideration, but we will look at how you've saved your deposit to make sure that you can afford the monthly mortgage repayments. And finally, the property itself. So if it's a new build property, it's turnkey condition when you're moving in, that's great. If it's not, it could be a doer-upper, or like Niall said, plenty of people are choosing to renovate their properties. So if that's the case, you may need a structural survey. So that's an additional cost that you need to take into consideration. But also, if there is a lot of works to be done, we need to look and see how you're going to afford these works. Do you have enough funding in place? Do you need to apply for additional lending? Basically, that you can afford the upkeep of this property. You will be required to provide a valuation. So there is a panel of Bank of Ireland approved valuers. So they basically go out, view a property, make sure everything's in order. And the general cost of this is between 130 to 150 €50. So it's really just to make sure that what you're buying is suitable for what you need. Okay, and then on the next slide, what I will look at then is just a tips checklist really. So savings, the size of your deposit is not the only consideration. So you do have to demonstrate a savings habit. So if I said before, you're getting a gift, Help to Buy, inheritance, you still need to demonstrate that you can afford a monthly mortgage commitment. So this could be through rent. If you're not paying rent, you do need to demonstrate a savings habit. So we would advise you to consider a regular savings account, or if you're with Bank of Ireland or would like to open a mortgage saver account, this is designed for first-time buyers. So the mortgage saver account, it's a monthly direct debit account. It's a minimum of €200 per month. And you can also add in additional lump sums as and when you need to. The main benefit of a mortgage saver account is if you have this open for a minimum of 6 months with no withdrawals, you will be able to avail of a €2,000 cash bonus if you draw down a mortgage with Bank of Ireland, and that will go straight into the account. We also need evidence of the source of funds, and we need to ensure that you have access to the funds when you need to. So basically, they need to be liquid funds. If it's in a notice account or a stock account, can you access those funds when you need to, or are they locked away for a certain period of time? And then to do so, use your bank account to document and evidence rent paid. So if you are paying rent in cash, we usually can't take this as your repayment capacity. Because if you're withdrawing cash, we don't really know where that cash is going. So you do need to make sure it's paid by direct debit or standing order or an online transfer. You can reference this as rent or your landlord's name, or if you transfer to housemates, but we basically need evidence that you've been paying rent for 6 months prior to getting a mortgage. We would recommend investigating supports available to you, such as the Help to Buy scheme, and do consider a mortgage application early, even before you find a property. So with ourselves, we do offer a house hunter application. So basically you've provided all your documents to ourselves, it's been assessed, and you get your underwritten approval in principle, and that lasts for 12 months. So at least whenever you are starting to house hunt, you know your budget, you know what the bank will give you, so you can look at properties that align with that. So as well as that, a lot of vendors and agents are actually asking for your proof of funds or approval in principle before you're allowed to go to viewings at the moment. So loans, so existing loans will be considered. So as I mentioned before, that's under your financial commitment. So if it's a large monthly financial commitment, it may reduce the amount that you can borrow. If you have had a loan and you close it early, we can use this towards repayment history or repayment capacity. If you do need to consider the interest rate you pay versus the interest rate you earn. But what I would say is your existing loans, some people feel that they need to use their savings to repay their loan early. That might not be the case. If you do have a loan, definitely talk to us to see if it works in with the mortgage. So do check you have enough funds available. So you do have to have funds for your deposit, but also other funds that will, or expenses that will come up. So stamp duty. Stamp duty is 1% of the purchase price, and legal fees can be between €1,500 to €3,000, depending on the solicitor. Other fees would be your valuation and a structural survey. And you also want to make sure you do have a bit of a surplus whenever you move into the property, so that you have enough money to kit it out for furniture and stuff like that. So you want to be able to make sure that you can repay your mortgage and still have enough money to enjoy your new home. Okay, so then finally on this next slide, I'll go into what Bank of Ireland actually offer you. So if we flick on there, please, thank you. So what Bank of Ireland offer, the mortgage saver account. So I kind of went through that on the slide before, but it's your direct debit savings account designed for first-time buyers. Minimum direct debit of €200 per month, and you can put in lump sums as and when you like. If you have it open for a minimum of 6 months and you draw down your mortgage with Bank of Ireland, you get an additional €2,000 cash bonus into your savings account. Okay, you don't have to be a Bank of Ireland current account customer to avail of this. You can open it up and pay your direct debit from your own current account, wherever that may be. We also offer cashback. So this is on top of the mortgage saver bonus for first-time buyers, but everyone can avail of this cashback offer. So it is 2% of the loan amount, and that's paid on drawdown. So it usually goes into your current account within about 40 days after you draw down your mortgage. And then you get a further 1% in 5 years if you have a Bank of Ireland current account and you've met the terms and conditions of your mortgage. We offer competitive fixed rate options. So we offer 1, 2, 3, 5, and 10-year fixed rates starting from 2.9. Okay, with our competitive fixed rate options, we also offer our green mortgage rates. So if you are building or getting a new build or have a property which is A, rated energy efficient, you will get a 0.2% discount across our fixed rate options. We also have a fixed rate option if you are borrowing more than 400,000. Okay, so this is called a high value mortgage rate. It's a discounted rate over 5 years, 2.5%. But with that rate, you forego the cashback offer. So we do have a various range of different rate options, whatever suits yourself. Then we also have flexi options. So for example, we have 3-month payment breaks. We also offer a 3-month deferral period at the start of the mortgage if you want to. So if you do find whenever you're moving into your property that you will have big expenses to kit the place out or for additional expenses, you can defer your first 3-month repayments and these will be added on to the term of the mortgage. Or after 2 years, you can take 3-month payment breaks whenever you want, okay? You can also skip months. So by skipping months, you can pay over 10 months rather than 12 months. So some customers prefer to skip December and the summer month and make the repayments over 10 months. And you can also overpay to save interest. So with ourselves on a fixed rate, you can overpay by 10% per month and there's no penalty or fee. This is also optional, so you can add it on and take that off at any time you like. And then the green mortgage rate if you have your A rate at home. So that's the main benefits of what Bank of Ireland offer. I would suggest if you are considering a Bank of Ireland mortgage, definitely talk to us. On the next slide, it has my email address and mobile number, and I'll be more than happy to go through your individual circumstances.